Assalamu alaikum. Very good evening. Thank you very much for joining our sessions. Today's session is related to International Financial Reporting Standard 2, share-based payment. I would like to highlight certain points, certain matters which need to be taken care of while attending this session. Number one, have a notebook and pen ready, but do not try to write everything because these slides will be sent to you people by the ACCA, and a recording of this session will also be available after some days. Be attentive. So toffees and chocolates can help in this regard because so many concepts are tightly linked with each other. So a point may not be understandable if a related earlier concept is not appreciated. Members and other professionals sitting in groups should not start commenting until the session ends. Otherwise, this will impair the hearing of others in the group. And you can ask questions. We shall be communicating you people about the timings when you can ask your questions. We cannot answer all questions, but I will try to answer as many questions as possible. And then I shall try to cover this standard to greater extent, but may not be 100% because we have only 3 hours, and I will try to cover it practically, and sometimes it takes a little longer than when you discuss something purely in a theoretical manner. International Financial Reporting Standard, share-based payment. See, entities often grant shares or share options to employees or other parties. Share plans and share option plans are a common feature of employee remuneration for directors, senior executives, and many other employees. Some entities issue share or share options to pay suppliers, such as suppliers of professional service. Until this IFRS was issued, there was no IFRS covering the recognition and measurement of these type of transactions. Concerns were raised about this gap in IFRS, given the increasing prevalence of share-based payment transactions in many countries. Share options are often granted to employees at an exercise price that is equal to or higher than the market price of the shares at the date the option is granted. Consequently, the options have no intrinsic value, and so no transaction is recorded in the financial statement. But this leads to an anomaly, because if a company pays its employee in cash, an expense is recognized in profit or loss. But if the payment is made in the share options, no expense is recognized. This was the anomaly. This was the reason that this standard was introduced. See, its basic principles are very simple. We shall be covering the concept like, number one, what are the accounting treatments of different types of share-based payments? Number one concept. And second concept will be like, if there is any change, any modification, any cancellation in these payments subsequently, I mean after initial recognition, if there is any change, what will be the method for accounting for those changes? So these are the two main areas which I will try to explain to you people with the help of a few illustrations. See, like other standards, this standard is not without argument. people feel that there is no need for this standard. They were against the recognition of share-based payments. So let's see one by one why they were against the recognition of share-based payment. Their first argument was, I hope you people can hear me today properly. Please respond with yes if you can hear me properly, so that I could have an idea that I'm reaching you without any interruption. Thank you very much. A lot of people are saying yes, thank you very much. We got your message. See, first argument was, like, there is no cost, therefore there should be no charge. Only company is issuing a paper, so there is no cost. See, this argument is wrong. An employee works for the future options as well as for a current salary in cash. If you hire a person and tells him that, for example, 100,000 will be your monthly salary, plus if you complete 3 years with us, with this organization, you will be given this much share options. So when this person is working with us, he is not only working for the cash which he receives at the end of each month, rather he will also be having that share option in his mind. So this argument is technically incorrect. So there is a cost. Number two is a share-based payment affects EPS twice. We know that. EPS formula, in the numerator, you normally takes the profit, and in the denominator, number of shares. When you will recognize share-based payments, so this will increase your expense. Increasing expense means your profit will go down and the numerator of EPS will go down. And similarly, denominator will also be affected because number of shares will increase as a result of issuance of those share options. So this objection, this is valid. EPS is affected twice, but we need to keep it in mind. This is because there are two different economic events. The numerator reduced because of consumption of resources received in exchange for the shares, that is services of employee, and the denominator is increased because of issue of share options. So this was the second. The third one is that a share-based payment has adverse economic consequences. Companies would be discouraged from introducing employee share plans if they had to recognize them in the financial statements. This argument is valid, that the companies cannot be, but the point is, though this argument is valid, we cannot allow a company to not to account for these share options. This is because it would distort their reporting. Therefore, it should be accounted for. So these were the argument against the recognition of the share-based payment. Number one, no cost, no charge. This is incorrect, because an employee will be having that share option in his mind in addition to his or her cash salary. Second is, this argument is like EPS effect on EPS is doubled. That is also correct, but these are two different economic events. You are receiving the services of the employee against those share options. And the third is correct, but we cannot allow companies, standard sector cannot allow company to, on the basis of this, that this will affect their financials negatively. Okay, this was our basic discussion. Then there are points which we should keep in our mind while discussing or while learning about International Financial Reporting Standard 2. There are certain transactions which are not, which apparently seems within the scope of this standard, but in fact they are not in the scope of this standard. Other standards will be applicable to those transactions. The number one is transactions with employees and others in their capacity as a holder of equity instrument of that entity. For example, an employee who is also a shareholder receives share under a right issue. So he is receiving those shares in his capacity as a shareholder of that company. He is not receiving those shares in his capacity as an employee in compensation for the past, current, or the future services. So number one point is the transaction with employees and others in their capacity as a holder of equity instrument of the entity. This standard will not be applicable to this type of transactions. Second is the issue of equity instrument in exchange for control of another entity in a business combination. IFRS 2 is not applicable to the transaction in which the goods are acquired as part of net assets in a business combination. Therefore, equity instruments issued in a business combination in exchange for control of the acquiry are not within the scope of this IFRS. The contribution by an entity towards the formation of a joint venture and common control transaction is also not within the scope of IFRS 2. However, if the acquirer issues shares to employee in return for post-acquisition employee services, IFRS 2 applies. So normally in business combinations, sometimes we achieve this combination by the paper issue, by the issuance of the shares, though this is also an issuance of share and against which we receive the assets of the subsidiary, but this transaction is outside the scope of the IFRS 2. Then the third one is transactions within the scope of ISA 32 and IFRS 9. This means IFRS 2 is not applicable to the contracts to buy or sell non-financials items that may be settled in cash, other financial instruments, by exchanging financial instruments. Simply something which is being covered by International Accounting Standard 32 and IFRS 9, IFRS 2 will not be applicable to those transactions. And the last one is transactions clearly for a purpose other than payment for goods or services supplied to that. Transactions clearly for a purpose other than the payment for goods or services supplied to that. Standard is also not applicable to this type of transactions. Then we shall be discussing at length three types of share-based payments. The first is equity settled share-based payments, in which the entity receives goods or services in exchange for equity instruments of the entity, including shares or share options. This means this transaction will ultimately be settled in the form of equity instruments. So this will be termed as equity settled, as its name suggests that this transaction will be settled in equity. So this is one type of transaction. And the second is cash settled share-based payment, in which the entity receives goods or services in exchange for amounts of cash that are based on the price or value of the entity's share or other equity instruments of the entity. You buy some goods or services and you agree to pay for those services like equivalent to to the value of the 1,000 shares, equivalent to the value. You will be paying, in fact, in cash, but what will be the amount of that cash? That will be determined by looking at the value of 1,000 shares. So this is cash settled share-based payments. And the third one is hybrid transactions, in which the entity receives or acquires goods or services, and either the entity or the supplier has a choice as to whether the entity settles the transaction in cash or other assets or by issuing equity instruments. If anybody has any question related to the material discussed so far, please feel free to ask.
As Karmi asked, could you please elaborate point 4 again and the scope of this?
Point 4 again, yes, Mr. Abbas. This is very important point. Like this point is IFRS 2 applies to those share-based payments which are made either against supply of goods or services. If you are issuing share or you are granting share options, and on the other hand, there is no supply of goods or services, so this IFRS will not be applied to that service or goods. Otherwise, I hope it should be clear.
How could entity receives goods from employee? Again, I'm asking.
Otherwise, for employees, normally we shall be discussing about the services, because employees provide services to the organization. Goods is for like other suppliers. Supplier could be for services as well, for goods as well. An employee could be an employee as well as supplier as well. If he is supplier, so that employee is providing the goods as well. So in either case, whether the other party is employee or other than the employee, and you are issuing the share to that party, make sure that that is being issued either against the supply of goods or services. Otherwise, I hope it should be clear.
Fasio Rahman asked, sir, can you kindly repeat cash settled equity based payment transactions most applicable on which industries?
Cash settled share based payment transactions. Who is this gentleman?
Fasio Rahman.
Fasio Rahman. Any company can use this method to make payments. I mean, it is not something which is industry specific. Please, next.
Hiram Shazadi asked, can you explain EPS point again?
Yes. Hiram, in case of EPS, let me go to that point. Yes. In case of EPS, what happened? Where is my pen? In EPS, what is the formula, Hiram? The formula is profit in the numerator. Here the formula will be, let me use this. Okay, the formula will be, let me use another sheet. Like I should use this Word document. New sheet. Okay. Okay, it should work, I suppose. Okay, by the time this board works, I'll try to explain it other way. Like in EPS, profit in the numerator and number of shares in the denominator. See, when you recognize share-based payment, this affects your profit negatively. So this means your EPS will go down. Your EPS will go down because your profit is decreasing as a result of recognition of share-based payment as an expense, as required by this standard. Similarly, when you will be issuing the share options, so this will affect your denominator as well. This means your EPS, the effect on your EPS is twice. Iram, I hope it should be clear.
Abhas Karni said clear, and
okay, next question.
Okay. Thank you, sir.
You are welcome, Iram. Next.
Okay. No more questions.
Okay, let's move further. Okay, first of all, before discussing these three types of payments one by one, let's have a quick look on the important definitions. Like the first definition is vesting conditions, because these definitions will be used in our discussion. The conditions that must be satisfied for the counterparty to become entitled to receive cash, other asset, or equity instrument of the entity under a share-based payment arrangement. Those conditions which must be fulfilled before the other party is entitled to receive cash or other asset or equity instrument under the share-based payment. So these are the vesting conditions. Vesting period is the period during which all the specified vesting conditions of a share-based payment arrangement are to be satisfied. So these are the two definitions. Next is vesting conditions can be of two types. Sometimes your vesting conditions are market-based, and sometimes your vesting conditions are non-market-based. What are the example of non-market-based vesting condition? Mean which are not based on the market conditions. If we want to define it in a single line. So what are the examples for this? Employee completing a minimum period of service. So you say to your employee, if you complete 4 year, 3 year, 5 year of your service with our organization, you will be entitled to this much number of share options or shares, something like this. So this is non-market based. Achievement of minimum sales or earning targets. Achievement of a specific increase or profit or earnings per share. Successful completion of flotation if a company is in the listing process, and you motivate your employees that like they will be given share options if they successfully complete this process, and then completion of a particular project. These are the examples of, in fact, non-market based vesting conditions. Then there are market-based vesting conditions, mean these depends on the market fundamentals. Like for example, a minimum increase in the share price of the entity, a minimum increase in the shareholder return, a specified target share price relative to an index of the market prices. So these are the examples of market-based vesting conditions. Other definition is grant date. Grant date is in fact the date at which the entity and another party including an employee, agree to a share-based payment arrangement, being when the entity and the other party have a shared understanding of the terms and conditions of the arrangement. At grant date, the entity confers on the other party, the counterparty, the right to cash, other assets or equity instruments of the entity, provided the specified vesting conditions, if any, are met. If that agreement is subject to an approval process, for example, by shareholders, grant date is the date when that approval is obtained. Example is Jupiter Limited offered a right issue to employees in March 2026. The issue was subject to the approval of the shareholders. The issue was approved by the shareholders on 15 April 2026. The grant date was therefore 15th April 2026. So this is basically the definition of the grant date. This is also important in understanding the application of this standard. Then is the definition of the intrinsic value. Intrinsic value is very simple. The difference between the fair value of that option, share option, or market value of, in simple words, market value of that share option, and the exercise price of that option. The difference between the fair value of the shares, to which the counterparty has the conditional or unconditional right to subscribe, or which it has the right to receive, and the price, if any, the other party is or will be required to pay for those shares. For example, a share option with an exercise price of $15 on a share with a fair value of $20 has an intrinsic value of $5. See, intrinsic value could be 0, but intrinsic value cannot be negative. You might have heard the term in the money, out of the money, at the money option. In fact, intrinsic value will only exist when your option is in the money. Mean the fair value of that option is higher than its exercise price. The holder of that option will benefit from exercising that option. That benefit is only possible if he can buy something at a lower price, which is the exercise price, and can sell in the market at a higher price. So this means intrinsic value is the difference between the market or the fair value of that share option and the exercise price. So this is the intrinsic value. Next is the definition. Okay, so this was all about the important definition which I wanted to highlight for you people. Now we shall be discussing the first type of share-based transaction, which is equity settled share-based transaction. How we will be treating it initially, and what will be the entries subsequently, how we will make the calculations initially, and how we will make the calculations subsequently. See, whenever you buy goods or asset, see, I suppose my pen should work. So how can I make sure that it should work? Do I try? Let me try something. It was working before the start of this session. Let me try, because this is very helpful. Anyway, what I can do, I can use this keyboard instead of this board for making you understand what I want to make you understand. Okay. Okay. When we buy goods or services, what is the double entry? Very simple. The double entry is, for example, debit, stock. For example, we buy goods 5,000 in credit, like credit cash. Credit cash. 5,000. Similarly, what will be the entry if you pay salary to your employee? So this will be like salary expense debit, like with they say 10,000, and credit cash or bank. Say cash 10,000. Very simple entry. If you buy an asset, asset will be debit and cash or bank will be credit. Same entry will be applied in equity settled share based payment. Debit will remain the same. By using those equity settled share based payment, either you will be buying goods or services. The party involved may be your employees or outsiders, means suppliers. So debit will remain the same. Debit will be either salary expense or the stock or like asset or goods. Debit will remain the same. Now, what about credit? If it is this much simple, so why we are studying IFRS 2? No, it is simple, but this does not mean like I'm trying to correlate with the basic concept, because all these standards are developed from a basic consistently applied framework. So debit will remain the same. Now what about the credit? If you are paying cash, of course cash will be credited. If you are like paying through bank will be credited. But if you are promising with them that, okay, we will issue you this much number of shares, so issuance of shares is neither cash nor bank. This is equity. So this means your equity will be credited. Equity reserve will be credited. So this is the simple entry for equity settled share based payment. I mean, for example, debit, whatever, like expense, salary expense, as I mentioned on the first two entries, salaries expense, or like stock, whatever you are receiving, these accounts will be debited. This is the same as we have seen in the first two entries. Now, what will be credited? Credit will be neither cash nor bank, and similarly, or liability, because we are promising with them that we will be issuing you the shares. So this will become equity, because this expense, this stock and this asset will be paid through the issuance of shares. So this will be the initial entry. This will be the initial entry. No question arises. I hope up till now it is clear. No question arises with what amount? Like in the first two examples, it's very simple. We know stock worth 5,000, salary expense 10,000. Here, when we talk about salary expense or stock, it has got worth, but standard has given some guidelines in this regard. Standard says, if we come back to our slide, standard says if the entry will be, like I have mentioned, this is the entry. Goods, services, expense, asset will be debit, equity credit. Now the question arises, how to measure the X? In case of parties other than employees, this X will be fair value of the goods or the services received. Meaning, like if you are buying stock against equity settled share based payment, so there will be a fair value of that stock. If you are buying an asset against equity settled share based payment, so there will be a fair value of those assets. So you will be debiting, X will be the fair value of that expense or asset or stock. Of course, the same amount will appear against the equity account. But the starting point is the fair value of the goods or the service or the asset. This is in case of parties other than employees. In case of employees, the starting point is equity. Because what is the worth of the services those employees? This can be subjective. Though subjectivity could be there in case of suppliers. But the level of subjectivity is higher in case of employees. So that's why standard recommended that the starting point for measurement of the amount should be the equity. You will be calculating the fair value of the equity instrument granted. This will become the X. The only difference is, in case of employee, at grant date, you will calculate the fair value of the equity instrument granted and credit this amount, the same amount will be debited. But in case of parties other than employees, the starting point is that very asset, that very expense, that very stock. You will be debiting with the fair value of that goods, stock or asset. The same amount will appear against the equity account. So this is the, in fact, initial journal entry for initial measurement. Let's have look at it with the help of an illustration. This illustration is in front of you. Here we shall apply this illustration to understand about the initial journal entries of equity settled share based payment. On 1st January 2011, an entity grants 200 shares options to each of its 800 employees. Each grant is conditional upon the employee working for the entity until 31st December 2030, meaning 3 years. The fair value of each share option is rupees 20. During 2011, 40 employees leave and the entity estimates that 20% of the employees will leave during the 3-year period. During 2012, a further 50 employees leave and the entity now estimates that 25% of its employees will leave during the 3-year period. During 2013, a further 20 employees leave. Note, face value of each share is rupees 10 and the exercise price of each share option is rupees 12. Calculate the remuneration expense that will be recognized in respect of the share-based payment transaction for each of the 3 years ended 31st December 2013. So there are 3 years in fact. We shall start from 2011. 2011 will end on 31st December 2011. But this option will vest over a period of 3 years, 2011, 2012, 2013. First of all, we shall calculate the total remuneration expense. That will be calculated. Mr. Khayyam, can you please help me in looking at what is the problem with this pen, so that if we could resolve it. So this is good, because this pen is needed to illustrate certain things. I suppose it should work. Can you unplug and replug it? This may work. Okay, let's see. Started. I suppose it should. Just not working. Okay. Okay, no problem. Okay, let's discuss the first thing. I'll try to be as quick as possible in typing. Anyway. Okay, 2011. I suppose everybody can see this screen very clearly. 2011. Let me increase its font. Make it bold. What will be the remuneration expense? The remuneration expense will be total remuneration expense. Total remuneration expense will be share option per employee into expected number of employee at the end of third year into fair value of the share option at granted. Fair value is fair value of share option at granted. So there are in fact 3 elements: share option per employees, then expected number of employees which will remain there who are expected to be entitled to receive these share options. See, if we look at this formula in the context of the equity settled share based payment, I am assuming that subsequently there is no modification, there is no cancellation. So this will remain the same, constant. This is also constant, assuming subsequently there is no change. Because subsequently we shall be discussing modification, cancellation, addition, deletion, things like this. We are assuming that that nothing will happen to this option subsequently. So what will be the how can we calculate the total remuneration expense? In total remuneration expense, these 2 things will remain constant. There will be a change in the expected number of employees at the end of year 3. You might have a different estimate at the end of 2011. You might have a different expectation at the end of 2012, and similarly at the end of 2013. But by the end of 2013, you will be having an actual picture as well. Likewise, if we look at our question, we can see that here, okay, go back, let's go back. Here you can see that at the end of 2011, 40 employees actually left, but the entity estimates that 20% will leave in total. We have to be careful while looking at the situation. Theoretically, there could be a confusion, but because we are not discussing with reference to the question, we are discussing practically. In practice, like this type of contract are very clear. Does this 40 employees include in this 20%? So the contract will be very clear. Here in this question, 20% includes these 40 employees. It is not saying in addition to these 40 employees, the entity estimates that further 20% of the employee will leave. It is not like this. It is very straightforward. One, it is giving actual number of employees who left, and the second, it is giving a cumulative picture including this 40. So this is the picture at 2011. While making calculations of the remuneration expense in respect of this equity settled share-based payment, we shall be ignoring the information given about 2012 and 2013, because practically at the end of 2011, we shall not be having this information. So what will be the entry, like if we come back to our calculation? We come back to our calculation. So this will be like here, here we have this one. Like here, share option per employee. How many share options per employee? 200 options per employee. I think I should increase its font size. Say I used it. 200 employees. Then multiply it with then fair value of the share option at the grant date. It is given in the question, and that is 20. So these two figures are from the contract. Very clear. These two figures are from the contract. Now, at the end of 2011, we will look at the information about the estimation. Like the information says 20% employee will leave by the end of 3rd year. So this means out of 800 employees, we shall be having only 640 employees who will be entitled to receive these share options. So this will give us, the figure will be we have calculated here. Okay, yes, we have calculated here. So this will give us 200 into 640 into 20. This will give us a figure
25,60,000.
25 lakh
60,000.
60,000. This will be the figure. Now, this figure is a cumulative figure, and this amount will vest over a period of 3 years. And at the end of first year, we shall be recognizing only 1/3 of this amount. So we shall be multiplying this amount with 1 divided by 3. We shall be multiplying to calculate the expense to be recognized for 2011. So the entry will be simple. Remuneration expense debit, because 1 year is completed, employees has rendered their service for a part of the total vesting period. So for that part, we shall be recognizing a part of the total expense. So that is 1/3 of the total expense. So this will be 85333. 853,333. So debit remuneration expense, credit equity reserve with the same amount. So this will be entry in 2011. Do we have any questions? So that before
lots of questions are there.
Please.
Muhammad Suhail Ahmed asked, please explain disclosure requirements of IFRS 2 with examples.
Muhammad Suhail, you are very right, but I would request that, because in this session we have limited time, so whatever we are discussing, so please ask question with reference to that area. Of course, disclosures are there, but I'm afraid I'm not going to cover disclosures in this session.
Altaf Hussain asked you to provide vesting condition with real-time examples. To provide example.
Vesting condition, Altaf, see, this illustration is an example. The vesting condition is the completion of 3-year period. So this is vesting condition, but this is non-market based, but it doesn't make any difference. But this is a vesting condition that the employee will have to complete 3 years. Altaf, I hope it should be clear.
Rashid asked why intrinsic value could not be negative.
Why? Rashid. Rashid, can you answer one question? I will be explaining according to that. If there is an option, like you have an option to buy dollar at rupees 110. Rashid, are you with me? If you have an option to buy dollar at rupees 110, and in the market the dollar is being traded at rupees 120, will you exercise your option, Mr. Rashid? Mr. Rashid, will you exercise your option?
He is not responding.
Rashid, are we still connected with each other?
Said yes.
Yes. Why? Because you will be making 10 rupees. So this 10 rupees is in fact intrinsic value. The profit which you will be making by immediately exercising your option. But what if the dollar price in the open market is only rupees 104? Will you be exercising your option? The answer is no, because it has got no intrinsic value. So intrinsic value cannot be negative. Intrinsic value either is 0 or positive. Rashid, I hope it should be clear.
Awais Karni asked, with the exception to shares and cash, could asset be exchanged against services goods received?
Ah, yes, it can be. It can be, but this standard will not be applied to those transactions. Next.
So can I ask, with regards to grant date, offering of right shares is not outside the scope of IFRS 2?
What is her name?
Sukena.
Sukana, you are right. It is outside the scope because right issue is in fact the issuance of shares to the shareholders in their capacity as a shareholders.
Karni asked, there is a confusion if you buy goods and settle this through equity instrument. Does this falls under the standard of financial instrument or share-based payment?
Who is this gentleman?
Awais Karni.
Awais, if you buy stock, I give you the example of futures. If you enter into a future and the ultimate objective is to hedge your manufacturing cost, this means you will be settling this contract net cash. You are not in fact interested in the goods. And we have seen in the scope, point number 4, that if you are not receiving services or goods, the issuance of share will not be treated under IFRS 2. Or to make it more simple, you will be applying IFRS 9 when those goods, when you are hedging those goods, in fact. Only then you will be applying the hedge accounting on things like this. IFRS 2 will not be applicable to that. I suppose it should be clear. Or if you have any other aspect which you want to specifically discuss, that is anything. Next.
Mohammed Asad Siddiqui said, you earlier said that in a rights issue, even for employees, IFRS 2 won't apply, as the employees are receiving shares in a capacity of shareholders.
Yes.
But later in one of the example of some Jupiter company, there is the same question of rights issue in employees capacity. But there you applied IFRS 2 principle. This is indeed quite
okay. Okay, let me go back to our example. Then this will this can give us a better idea. In Jupiter example, see. Okay, let me go back to where is that example. I suppose it should be here. Yes, is this the example? Who is this gentleman?
Asad Siddiqui.
Asad, see, this example was used to just illustrate the concept of grant date and nothing else. This does not mean that this example or this issuance of shares will be treated under IFRS 2. This example is only used to illustrate the concept of grant date and nothing else. You are very right. There is no conflict, but this example just need this explanation. Then here we are not applying IFRS 2. This is only for the explanation of grant date concept. I hope it should be clear.
Yes, I think it should be clear to Asad, but he's not replying.
So can you tell us?
Yes, he said.
Okay, thank you. Okay, next.
Next, Miss Sukena asked another question. How fair value of share option at 1st January 2011 can remain constant? It may change by the end of 31st December 2013.
Sukena, you are right, but this is required by the standard that we shall be applying the fair value of the share options, which is prevailing at the date of inception of this contract. Then this will remain the constant. This will not change. This is something required by the standard. Next.
Why using fair value instead of par value?
Par value. Par value is par value in fact does not reflect the true worth of the instrument. So that's why standard requires the usage of the fair value. And usage of fair value is also being encouraged in other cases as well. That's why a separate standard has been introduced in relation to this concept.
Kunal Rupani asks, is there a time period as per standard to report disclosure for share-based payments?
Time period. See, whenever you are making your financial statements, so if there is any share-based payment, of course you will have to account for those items.
Fateh Fakhri asks, if the vesting period lapsed, what will be the impact on the accounting treatment?
Fateh, you're welcome. I mean, you are a regular. You regularly attend our sessions. Thank you very much, and your feedback is very important. Anyway, coming to your point, we shall be discussing this point. And if it is not specifically discussed, then please feel free to ask this question again. Next.
Inzam asks, in the same illustration for years 2012 and 13, the salary expense, should we show them payable or not? Please.
Yes, we are coming to the next year. We are coming to the next year, and that is like over here. So this is 2011. Now move to the 2012. For 2012, we have some material here over here to copy paste here. So at least if we are not using pens, so we can do something with like feature given in the this Word, Microsoft Word. Okay. So for 2011, yes. For 2011, we shall be calculating the remuneration expense again, keeping in view the expected number of employees. Again, I mentioned with red color those items which will not change, like share option per employee will not change, and the fair value of share option at grant date will not change as required. I mean, at least the third one is required by the standard. Now, what will change? This will change. Now we moved further into the future. Like now we are at the end of 2012. So we received some other information. If we go back to our illustration, we can see that in this year, the situation is like 50 employees left, and the entity estimates that. I suppose it should be, because it should be like this. Entity estimates that 25% of its employee will leave during the 3-year period. So this means 25% of 800 will not be there at the end of third year. So this will give us 75% of the employees. So 75%,
600 employees.
600 employees. So this will give us 600. So when we multiply 200 into 600 into 20, this will give us
24 lakh.
24 lakh. 24 lakh. Okay. So this is the total remuneration expense, expected total remuneration expense at the end of second year. What we will do, we shall be calculating, because the vesting period is two-third. So we shall be multiplying 2 divided by 3 into
1,600,000.
This will give us how much?
1,600,000.
1,600,000. So this is the amount. This is the total amount which should have been recognized till 31st December 2012. Out of this amount, we have already recognized in 2011 88. We have already recognized 853333. So the amount which should be recognized will be 16 minus 853. This will be the amount which will be recognized in year 2, and that is 747. This will be this amount. This is the amount which will be recognized as a remuneration expense in 2012. Do we have any question about 2012?
Muzammil Sultan asked 14 plus left also during 2011. Why it is not included in your calculation?
Muzammil, actually every year we shall be recalculating the total remuneration expense, and our previous total recalculation will be irrelevant. We used that total remuneration expense just to calculate the expense for that particular year, and we recognized only that particular amount, 853,333 in year 1. So far as the rest of the amount is concerned, we have not treated this amount. So that's why in second year we recalculated the total remuneration expense. But now 2 years has elapsed. So we calculated the total expense for 2 years, and then we know that we have already recognized for the first year the expense, and now we can calculate the amount to be recognized as expense in the second year. I hope it should be clear.
Altaf Hussain asked on which date we will record the entry in 2011. Either it is 1st of January or 31st.
At the end, because by the end of the year, your employees has rendered those services which entitled them for this benefit. At the start of the year, they have not rendered the services. So once they have rendered the services for that particular year, only then they are entitled, and only then you can pass that entry. Before that, you cannot.
Hamad Ahmed is looking for treatment or expense required for those employees who are leaving in 2011.
Nothing, because as we discussed, we are only sorry, I think there is some issue. Okay. Who left? They are not entitled, so we do not have any liability, or so that's why we shall not be recognized. Of course, that is being automatically reversed in the future calculation. Like in year 1, you were recognizing 853,000, and because now we expect like more employees will leave, so that effect that affect the calculation of the expense for the second year. That is benefiting the company, in fact. So you and a reduction in the expense is showing this effect, in fact. Yes.
Rashid asks, please explain why we are not taking into account actual employees who left, and why we are using estimated employees.
Rashid, see, even if you look at IFRS 15 or any other standard, your liability is that which is expected to be paid. Sometime when you grant an option and there are like 2,000 or 3,000 employees, this 3,000 number is not relevant. Actually, what will be your cost is dependent on the number of employees who will remain there at the end of vesting period. So in fact, we are calculating the liability at the end of vesting period. So if someone is not there, he will not be entitled to that benefit. So that's why that is not our expense. Similarly, if something is not our expense, liability cannot arise. I hope it should be clear. Yes, next.
Muhammad Nan asked how the estimate is made in real world.
Similarly, in real world, you look at your historical data, your labor turnover, your staff turnover, and similarly, you might have improved your working conditions. So this may affect the number of employees which will leave in the future, or your working condition may be worse off. In that case, you will estimate the number of employees accordingly. There are different methodologies, of course. The history is one thing. If the company is new, you can look at similar companies. What is the labor turnover? What is the staff turnover? So that can help you in the determination of the people who will stay with you.
Rashid again asked, as you just said, if the entry is booked at the end of the year, then why we are taking estimated employees instead of actual employees who left?
Who is this?
Rashid again.
Rashid, if you just look at the question very carefully, so in order to calculate the total effect, we have to see the whole picture. Like at the end of second year, we want to see what will be the total number who will remain with us. I think that we should move next. Okay, Rashid, I hope it should be clear. Next question is, next is 2030. Okay, 2030. Let me copy from here. 2030. Rashid, here in 2013, you can see that now we are exactly at the end of the vesting period. We are exactly at the end of the vesting period. Here we have the real picture. Here we know the exact number of employees who are in fact entitled at this point in time. Like here, what is the situation? Like instead of 600, we will be looking back and see how many people are there. How many people are there? Like if we just look back and see our question, we can see that 40 employees left in 2011, 50 employees left in 2012, and 20 employees left in 2013. If we add up, this will become like 9110. So 110, 800 minus 110, this will become
690.
690. So this means this is the new situation. So this will give us the picture at the end of the vesting period. So I shall be recalculating it, and this will give me
27 lakh 60,000.
27 lakh
60,000.
60,000. So I want to expense out. I want to know how much. This is the total remuneration expense, revised estimated remuneration expense. I have already recognized 853,000 in 2011, 746,667 in 2012, and I want to determine how much need to be expensed out in 2030. So I'll be, because 3 years are completed, so the factor will be 1. This will become 1. And I shall be multiplying 7, 6, and this will give us this. Okay, this amount is already there. I'll be reducing it with the above two amounts: 853,303 minus 746,667. So this will give me the
11 lakh 60,000.
11 lakh
60,000.
11 lakh 60,000. So this is the amount which is the remuneration expense for, let me erase this so that it should not create confusion. So this is the amount which will be recognized as a remuneration expense in 2030. This is the amount. So this is the accounting for equity settled share-based payment. This is not the end. We are going to discuss other aspect of equity settled share-based payment as well. So this means simply your expense, your stock, your like asset will be debited as any other transaction, as when we buy an asset or stock, or we receive services. That asset will be debited, that expense or stock will be debited. Credit will be, in case of equity settled share-based payment, equity reserve. Equity reserve will be credited. Now there is a concept of vesting period. Like, fine, we agreed with our employees, like they will be given share options, for example. So what are the other conditions? If condition is like this, as we have seen in this illustration, like they will have to complete a certain period of their employment with the organization, with this organization. So then this benefit will vest over that period. Vest mean that period need to be that condition need to be met before they are entitled to this benefit. So every year, or when a part of that whole vesting period is finished, we shall be calculating the benefit for which we have received the services. So we shall be recognizing that expense as a remuneration expense against equity reserve. But what will be the formula? Simple formula. The number of options we have agreed per employee into like fair value of that share option at the date of inception into what you expect at the end of that particular period. How many people will be there at the end of vesting period? So you will be multiplying all these three amounts to calculate the total remuneration. Then you will be multiplying this with the factor which is related to your vesting period. In first year, we multiplied it with 1/3 because by the end of first year, only 1/3 of the vesting period was elapsed. So similarly, in year 2, we shall be multiplying it with 2/3. But this will give us the total estimated remuneration expense for 2 years, out of which we have already recognized an amount. So the remaining amount will be recognized in 2012. Likewise, let's move to the next concept. Okay, next is this was the illustration which we have just discussed. Vesting period. In this first illustration, we have seen that vesting period was fixed, that is 3 years. But the vesting conditions could be such that your vesting period is variable. In that case, what will be the approach? See, an entity needs to estimate at grant date the expected vesting period over which the charge should be spread. Let me open this in front of me as well, because I have to uh, turn my face to look at the screen, so it should be in front of me as well. An entity needs to estimate at grant date the expected vesting period over which the charge should be spread on the assumptions that the services will be rendered. The services will be, something is happening to this. I suppose we can have a self prayer break for a few minutes by the time our small technical problems can be resolved. That is not affecting connection between us, but it is affecting the opening of the file and the working of the board. You can say your prayer. I'm going to say my prayer. So, Khayyam, can you please look into this matter? Thank you. Please mute it. Okay, Ji, welcome back. Now, as we started discussion about variable vesting period. If vesting period is fixed, that's not an issue. If vesting, what this?
Yes, this.
Okay. I suppose we are reaching you people. If vesting period is fixed, the treatment is straightforward. But if vesting period is variable, our approach will be an estimate at the grant date the expected vesting period over which the charge should be spread on the assumption that services will be rendered by employees over this vesting period in exchange for the equity instruments. This means entity will also estimate the expected vesting period if it is variable. And based on that expectation, entity will start recognizing the expense over that expected vesting period. If the vesting period turns out to be shorter than the estimated, for example, you estimated like your vesting period will be like 4 years, but in fact it turned out to be 3 years. What is vesting period? In fact, this is the period over which vesting conditions will meet. So your conditions, you were expecting that those conditions will meet over a period of 4 years, but in fact those conditions meet at the end of third year. So this is the situation where the vesting period turns out to be shorter than estimated. The charge will be accelerated in the period in which the entity must fulfill its obligations by delivering shares or cash to the employee or supplier. If the actual vesting period is longer than estimated, the expense is recognized over the original vesting period. Example, we can use this example to make you understand this concept. Margie granted 100 options to each of its 4,000 employees at a fair value of $10 each on 1st December 2007. The options vest upon the company's share price reaching $15. This is the vesting condition. That option will be granted once the share price, please note this thing, once the share price reaches $15, provided the employee has remained in the company's service until that time. The terms and conditions of the options are that the market condition can be met in either year 3, 4, or 5 of the employee's service. At the grant date, Margie estimated that the expected vesting period would be 4 years. What does it mean? At the grant date, Margie estimated that the share price of $15, which is the vesting condition, will meet over a period of 4 years. But in fact, what happened, which is consistent with the assumption used in estimating the fair value of the option granted. The company's share price reached $15 on 30th November 2010, when it was granted on 1st December 2007. The first year is 30th November 2008, year 1, 30th November 2009, year 2, 30th November 2010, this is third year. We estimated at the date of grant that this $15 will achieve at the end of fourth year, whereas it is in fact achieved at the end of third year. Now what will happen? At the end of first year, if we just calculate the total remuneration expense, it will become like 1,000 option, 100 options, the same formula, number of options, which is 100, into 4,000 into like 4,000 employees, if we assume that all will stay, into, here we are assuming all will stay, into fair value at the date of inception. So this will give us total remuneration expense 4 million, and at the end of first year, mean on 30th November 2008, we know based on our estimation at the date of grant of this option, that this option will vest over 4 years. So this means 4 divided by 4 multiplied by 1 by 4, because at the end of first year only 1 year is completed out of the total vesting period. So the factor which will be multiplied to the 4 million is 1 by 4. So this will give us 1 million remuneration expense charge for first year. The same expense will be for second year. Now in third year, what happened? Vesting conditions meet. $15 share price is there. So, but when we calculate, so all the remaining amount will be recognized as expense in third year. This is the meaning of this line, which says, if the vesting period turns out to be 3 years than the estimated, which is 4 years, the charge will be accelerated in the period in which the entity must fulfill its obligation. Okay, let's look at its solution. See, at the grant date, At the grant date, 1st December 2007, Margie expects the market condition to be met in 2011. Estimated vesting period 4 years. Thus, the charge over the 4 years was calculated as 100 into 4,000 into 10 divided by 4 years is equal to $1 million per year. The market condition was actually met a year early on 30th November 2010. The expense therefore needs to be accelerated and charged in the year ended 30th November 2010. The charge for the year is calculated as follows. Total charge 4 less already charged in 2 years to 30th November 2009, 1 million into 2, charge in the year ended 30th November 2010, that is 2. Instead of 1, we have charged whatever is the remaining amount related to this benefit. This charge. Okay, now move further. On exercising options, at the end of the vesting period, because this was equity settled, so at the end of the vesting period, you will be issuing shares. You will be issuing equity instruments. So what will be the entry? Again, if you just recall the basic concept, whenever we issue shares, what is the entry? Like we received, say, cash. Cash will be debit and credit will be share capital with an amount equal to the number of shares issued into their face value. Any surplus will be recognized in the share premium account. This is the basic concept which we know from our earlier studies. The same concept will apply over here. When the option will be exercised, cash will be debit. Cash will be debit because you are receiving cash from the exercise of those share options, and then you have created equity reserve over the vesting period. So these two accounts will be debited because you are not only receiving cash, but at the same time you have developed a reserve over the period of vesting period. These two accounts will be debited. Credit share capital with an amount equal to the number of shares issued into face value of those shares. So the balancing figure will be share premium. This is very simple. That will become the balancing figure. Okay. And no adjustment of the recognized equity element after vesting date. If like something to which right is lost, like having recognized goods or services received in accordance with the standard and a corresponding increase in equity, the entity shall make no subsequent adjustment to the total equity after vesting date. For example, the entity shall not subsequently reverse the amount recognized for services received from an employee if the vested equity instruments are not later forfeited sorry, or in the case of share options, the options are not exercised. However, this requirement does not preclude the entity from recognizing a transfer with an equity, that is a transfer from one component of equity to another. What is this situation? If I discuss in other words, this will be like vesting conditions are met, vesting period is over, but nobody exercises those options. So we know that equity reserve is there related to these options. The entry which we discussed in the last slide is only will only be made if those options are exercised. But what if after vesting period options are not exercised? So the amount lying in the equity reserve will remain there. What maximum you can do, entity can transfer it within the equity, like if laws of your country allow you to transfer it to the other component of equity, you can do that. Otherwise, you will do nothing with this amount. So no adjustment of the recognized equity element after vesting date. No, this was to greater extent the material related to the equity settled. Of course, we shall be revisiting it when we will be discussing hybrid share-based payments. But now we move to the cash settled share-based payments. Cash settled share-based payments.
Do you want to take questions?
Yes, please.
Rashid Hanif asked, in case of variable vesting periods, don't you think there is an overstatement or understatement of expenses?
In case of?
In case of variable vesting periods, there could be overstatement or understatement of expenses.
No, it's not a matter of under or overstatement, because you are recognizing your expense, your initial estimate. If there is any change, standard allows you to account for that change. So this will definitely affect your expense. But that expense is being affected due to the change in the conditions, vesting conditions. Yes.
Adil Nasir and Madiha asked that as we were discussing equity settled transactions, why we have debited cash?
Why we have debited cash? Where we debited cash?
We debited cash when we were discussing the entry for the we have debited the cash and then credited the equity and then the remaining amount.
We debited the expense or stock or asset. Akila, can you specify?
Madiha.
Sorry, Madiha. Can you please clarify your question? Because we have not credited the cash. Sorry, in the last entry.
Yes.
Okay, Madiha, you are talking about, in fact, this entry. Madiha, when option is exercised, so there is an exercise price. If you look at the illustration, you will find that I suppose illustration is you will find that there is yes, in this illustration you can see that this option has got an exercise price of 12. So whosoever is exercising this option will be paying to the company 12 rupees per share. So this is the cash in addition to the equity reserve which you build up over the period, over the vesting period. Madhiya, I suppose it should be clear.
As Adil has asked a similar question, he is asking now, if we have delivered goods in exchange for equity shares, then why cash is debited? Same entry.
See, this is the situation of the share options. We have granted the share options against the services of employees, not goods. Akil, I hope it should be clear. Adil, I hope it should be clear.
Madhiya said yes, sir. Now I get the point. Okay. And Adil is, I think, writing to you.
Okay.
Not answered yet. Adil, no.
Adil, what was his question?
His question was that if we delivered goods in exchange for equity shares, then why cash is debited?
Adil, if we delivered goods, in exchange for equity instruments, then the entry will be, please note, debit equity reserve account, credit share capital and share premium. Cash will not be there. I hope it should be clear.
Okay, what about the employees who are entering their services, then why they are accounting for cash?
This cash requirement is in addition to the rendering of services.
If the fair value of share by that time goes down and exercise that was agreed was higher, what will happen in this case, Rashid?
Rashid, then these options will not be exercised and this will lapse. Now the next question is, what will happen to the equity reserve already lying in our account? So that will remain there. That will remain there. No adjustment will be made to that. Except, as I explained earlier, you can transfer this equity reserve to another component of the equity, but that will remain there. No adjustment will be made to this equity reserve. In that case, in the situation which you have just mentioned. Rashid, I hope it should be clear.
Atif said, do we have to consider the present value factor in share-based payments?
Share-based payment is basically incorporated into the determination of the fair value. You know that different models like Black-Scholes model and other valuation models are available for the calculation of the fair value. Time factor is taken into account while calculating the fair value. That factor is already there. You need not to separately calculate it. Of course, if you are determining the fair value, that factor will be there. That factor need to be considered.
No more questions.
Okay. Now move further. Now the cash settled share-based payment. The amount will not be paid by issuing shares. The amount will be paid by transfer of cash or other assets. Examples: share appreciation rights, right to shares that are redeemable. The amount of the transaction to be paid for will be based on the value of the entity's shares, but will not be paid by issuing shares. Examples of this type of transaction include, as I have mentioned, share appreciation rights granted to employees. The employees become entitled to a future cash payment rather than an equity instrument based on the increase in the entity's share price from a specified level over a specified period of time. Or an entity might grant to its employees a right to receive a future cash payment by granting to them a right to shares that are redeemable. Let's have a look at an example. These are the examples. Okay, initial measurement, the same concept. Initial measurement, the same concept. As we discussed earlier, whenever you buy something, goods, or you ask someone to render services for you, mean expense, and similarly asset, that particular expense, asset, or stock will be debited. Now here, at the end of the day, you will be settling it in cash or other asset, not in equity instrument. So credit will be the liability. If we just recall, the initial entry which we made in equity settled, the first difference is the credit. There we were crediting the equity reserve. Here we are crediting the liability, because this transaction will either be settled in cash or other asset. So this is our liability. Now the next question is, how can we determine the value of the X? This will be determined. The entity shall measure the goods or services acquired and the liability incurred at the fair value of the liability. So you will determine the fair value of the liability, and the same amount will be debited and the same amount will be credited. So this is the treatment, or this is the requirement for the measurement of X. Okay, let's discuss with the help of an example. The example is, A Limited purchased raw material from B Limited, on 20th January 2012. The amount to be paid in 31st December 2014 was determined as the value of 2,500 shares of A Limited. The amount will be paid in cash on 31st December 2014. But how much? Value of 2,500 shares at that point in time. Mean on 31st December, share price of this company will be multiplied with the 2,500 shares in order to determine the amount to be paid. So this is cash settled. This is being settled ultimately in cash. But why share-based payment? Because how much cash is dependent on the value of the shares and value of the 2,500 shares. On 20th January 2012, the entry will be very simple. You will be multiplying 400 with 2,500. So 1 million will be recognized on 20th January 2012. Mean stock debit with 1 million and liability credit with 1 million. On 31st December 2012, share price is reduced by 20. This means your liability is reduced. Initially, your liability was calculated on the price of 400. Now this price has changed. So your now what will be the effect? This 20 rupees per share mean you will be multiplying 2500 shares with this reduction. This will give you 50,000. Your liability will be reduced by this 50,000. On 31st December 2012, your entry will be debit liability by 50,000 and credit profit and loss account 50,000. Mean at the end of 31st December 2012, your liability is now 950,000. Please keep it in mind. Your liability is now 950,000 due to the change in the fair value. Then, when financial statements will be prepared on 31st December 2013, the share price is 390, which is increased from 380 by rupees 10. So this will increase your liability because your liability is based on this value and this value is increasing. And this value is increasing by rupees 10. So your liability will increase by 25,000. Rupees 10 into 2,500. Your liability will increase and you will pass an entry at this date because your liability is increasing. You will be crediting the liability by 25,000 and debiting, of course, profit and loss account. Second effect will go to the profit and loss account after initial measurement. So this will give now your liability at the end of 31st December 2013 will become, I suppose, 975. Like if we just multiply, we can check it like 390 into 2,500. This will give us, yes, 975,000 at the end of 31st December 2013. Now on 31st December 2014, you actually paid this money based on 385. Now remember, before this payment, what is our liability? Liability is 975,000. You paid as per the fair value at the date of payment. So you are required to pay 962,500. You paid this amount, but in fact liability is higher than this. This difference will again go to the profit and loss account. So this is cash settled share-based payment. Here you can see that another difference. The first difference is in equity settled, we are crediting equity reserve. In cash settled, we are crediting liability. This is the first difference. Second is in equity settled, fair value will not change for the purpose of the subsequent calculations of the remuneration expense or the equity reserve. But in case of cash settled share-based payment, whenever you want to calculate your liability, you will be using the fair value at that particular date. So their fair value is fixed in equity settled share-based payment. In cash settled share-based payment, this will change. This will be the fair value of that particular date will be used. So next is subsequent measurement. We have already done this, like remeasure the fair value of the liability at each reporting date. Like on 31st December 2012, I suppose, we recalculated it using the fair value, which was 380 at that date. Until that, and then again we used like 380 to calculate our liability. Then at the end of 2013, we used 390 to calculate the liability, and we paid at 385, and the difference was charged to the profit and loss account. So the same is written over here. We have already discuss this concept with the help of this example. Like remeasure the fair value of the liability at each reporting date. 31st December 2012, 31st December 2013, 31st December 2014, until the liability is settled and at the date of settlement with any change in fair value are recognized in profit or loss for the period. So this is the subsequent measurement. Okay. Okay, now come to the illustration number 5. Illustration number 5. Here we have, I suppose, illustration number 5. Illustration number, it's not there. Illustration number, yes, illustration number 5. M Limited grants 300 share appreciation rights. Let me open it here. Illustration number 5. So that I should have in front of me illustration number 2. Illustration number 5. Illustration number 5. Yes. Should be in front of me. Okay, M Limited grants 300 share appreciation rights payable in cash on 1st January 2011 to its 1,000 employees on the condition that the employees continue to work with the entity for the next 3 years. The employees can exercise their rights over the next 3 years. Following information is available. Year ending on 31st December 2011, employees actually left 70. Estimated additional employees leaving 120. Then on 31st December 2012, during this year, 80 employees left. And at the end of that year, it is estimated that further 50 employees will leave. And then in 2013, 100 employees actually left. On 31st December 2013, 200 employees exercised their rights. Another 280 exercised their rights on 31st December 2014, and the remaining 270 employees exercised their rights at the end of 2015. M Limited estimates that the fair value of the share appreciation right (SARs) at the end of each year in which a liability exists as shown below. At the end of year 3, all share appreciation rights held by the remaining employees vest. The intrinsic value of the SAR at the date of exercise at the year 3, 4, and 5 are also shown below. So these are the fair values and intrinsic value. Okay, required. Calculate the amount to be recognized in the income statement of each of the 5 years ended 31st December 2015. And calculate the liability to be recognized in the statement of financial position at 31st December for each of the 5 years. See, the same approach. See, there are 300 appreciation right SARs for each employee. This will remain the same as per the given scenario. Then there are 1,000 employees. This figure may change. We need to re-estimate it at the end of each accounting period. But 300 will remain the same. Then fair value of these SRA, SAR will also change. Only the fixed amount is, in the given scenario, is 300. Number of share appreciation rights. Estimated number of employees will change as the time passes, expected to be changed as the time passes, and in this we are allowed to use the fair value at the end of particular reporting period. So this means at the end of 2011, we will calculate the total remuneration expense by multiplying 300 with expected number of employees. And that expected is, if we just look at the table, we can see that 70 actually left at the end of 2011. And we expect that 120 in addition to these employees will leave. So this means this will add up to 190. 810 employees will be there at the end of the vesting period. This is the estimate at the end of 2011. So this means 300 into 810, which is number of employees, into fair value. Now we'll have to see the fair value at the end of 2011, the date at which we are going to make the entry for this expense, and that is given over here, that is 13.1. So this means 300 into 810 into 13.1. This will give us the total expense. This will give us the, let me use the answer. Answer is not there. Yes. See, 810 employees, 300 SARs, and this is the fair value. This is the, in fact, total remuneration expense. But we are only 1/3 of that period has elapsed, so we shall be multiplying it by 1/3 to calculate the expense related to 2011. So this will give us 1061,100. So profit and loss mean remuneration expense will be debited with this amount, and you can say remuneration expense, profit and loss account, and liability will be credited with this amount. Now at the end of the year, this will be our liability. Now in 2012, if we go back again, we need 300 SAR will remain the same. We need to re-estimate the number of employees because we have moved further into the future. So the information is given at the end of 2012, which is this. This says this is the actual picture, like 150 already left. And this is the actual picture till 31st December 2012. And we expect that additionally 50 more employees will leave. So this means in total, at the end of 2012, we expect that 200 employees will leave in total. So this means our estimated number of employees will be 800. 300 into 800. Now we want to calculate, we want to know the fair value of this option, of this SAR, and this is given over here, 14.5. So when we multiply 300 into 800 into 14.5, this will give us the total remuneration, revised total remuneration expense. So here in 2012, we can see that this is the total This is the total. I explained all these elements separately because this is the end of the second year. So till this date, we shall be multiplying by 2 by 3 to calculate the total remuneration expense after the end of second year. Now we shall be calculating the expense for the year by deducting the opening liability or the opening expense. Rather, it is better to say that you should deduct the opening, like the expense which you have already recognized. So this will give you 1,258,900. 1,258,900, and your liability will increase by 1,258,900. You have already recognized in 2011 an amount, and you further increased it by 1,258,900, and at the end of 2012, your liability will become 2.32 million. Similarly, in 2013, the situation will be no, there are two situations. What you will be doing here, this is the important point. This situation can arise practically. Like on 31st December, vesting conditions are met, and 200 employees exercise their rights as well, and another 280 exercise their rights on the 31st December, and the remaining 270 employees exercise their rights at the end of 2015. Okay, let's discuss the accounting treatment for this exercise. Exercise means you have paid cash to your employees based on the intrinsic value, because you agreed with them that you will be paying them the cash. And here we are supposing that cash will be paid based on the intrinsic value. Okay, so this means our calculation will have two parts. One, at the end of 2013, those employees who have not exercised their option, and those 200 employees to whom we have paid cash. And the actual position of the employees who are in fact entitled to this SARs is like 70 actually left, because now the actual situation is there. This means 250 employees left, and 750 employees become entitled to this SARs. Out of this 750, 550 employees have not yet exercised. They can and they will be exercising, as we can see from the information given about the other 2 years. And 200 employees exercise their right. So this means company has paid cash to 200 employees based on, as they agreed, based on the intrinsic value. Look at intrinsic value at the end of 2013 is, see, it is mentioned over here, please don't get confused, that the company said at the exercise date, which equals the cash paid out, the intrinsic value of the SCR at the date of exercise, company will be paying cash as per the intrinsic value. This is the actual cash paid out. This means we shall be multiplying 200 employees. Each employee is entitled to 300 SCRs. 200 into 300 into this 14 intrinsic value to calculate the cash paid. To calculate the cash paid on the options exercised. And for the remaining 550 who have not yet exercised this option, liability will be there. So 550 will be multiplied with 300 with 16.2, the fair value of this option. So the entry will be, or the accounting will be, this is the unexercised option. 550 employees have not yet exercised this option. Each employee was entitled to 300, and this is the fair value of the SAR. So this gives us the remaining liability. And this is the amount which was exercised. This is in fact the cash paid. So when we add up these two figures, this will give us 3513. This is the total remuneration expense as we used to calculate at the end of each year. Now this is the third year, no factor need to be attached, only we shall be deducting the opening liability. And this is our opening liability. We saw this figure at the end of 2012, as we can see from here as well. So this is the remuneration expense at the end. This is because we have not paid anything. So this was the closing liability at the end of 2000. We shall be deducting this liability from this total. This will give us 1193. This is the closing liability for 2013, and our entry will be debit cash because we have paid credit cash because we have paid cash, and this is the expense for this year, third year, and this is the balancing figure, which will be credited to the liability. So this is the journal entry, and this is the way you will be calculating when the cash settled share-based option, share-based payments are being exercised, and there are unexercised portion as well. So liability will continue for the unexercised portion. Okay, now in 2014, further 280 employees exercise their option, and the same way we shall be multiplying this with 300 and the fair value and the intrinsic value. This will give us the total remuneration expense. We will be deducting the opening liability. This will give us the expense for the year. Sorry, I wrongly mentioned expense for the year as if it was the closing liability. This is in fact the expense for the year. You can use this formula for the calculation of the expense for the year, and the double entry will remain the same. You have paid cash, so cash will be credited in this, and this is your profit and loss account, and the balancing figure will go to your liability. So your liability account will in fact become zero towards the end of this transaction. Similarly, in 2015, all the remaining employees exercise their option. So this way you will be calculating, and then when you reduce this with opening liability, this will give you 153,900. This is your expense for the year, and you have made this entry. You have like cash credit, because this is the actual cash which you have paid, and debit profit and loss account. Both figures are calculated from here, and liability is the balancing figure. And by the end of this is the account. If you can see that liability is building up, all this account is based on the entries which we made in the earlier part of this answer. You can see that this is building up here. Profit and loss account, we are charging it as an expense, and then in 2013 you can see that it is further building up, but thereafter it started decreasing, and by the end of 2015 it is reduced to zero. As we can see from when you will be looking at the recording, you can get more this will be explained to a further extent. Okay, now let's move further. So next is, we have seen the illustration. Now we move to the third part of our discussion, which is the hybrid situation, where that transaction can either be settled in cash or equity instrument. So this is hybrid. Now, who has this option? This will affect your accounting. Who has this option? After a few minutes, we shall be having a Maghrib prayer break. Anyway, we continue what we are discussing till that time. There are two possibilities. One is that option, that decision is lying with the option holder, the other party, not company. The other party will decide at the vesting date whether that party wants cash or shares. This is one situation. Other is the company will decide. The company will decide about the settlement. Will it pay cash or shares? The company will decide. So we shall discuss each of these options in turn. First of all, we are going to discuss when the other party, when the counterparty has a choice of settlement. When the counterparty has a choice of settlement. What will be the initial measurement? Now the situation is there is a share-based payment that can be settled either in cash or equity instrument. And who will decide? The counterparty will decide. This means company will not decide. So what will be the double entry? Again, debit will remain the same right from the start of this session. In all situations, debit was the same. It could be expense, it could be stock, it could be asset. Now we will see what will be the credit. What will be the credit? Credit will be X and Y. What is X? X is basically fair value of the debt instrument at grant date. And Y is basically fair value of equity alternative minus X. This means, first of all, this is the case of employee. If you just recall, when we discussed equity settled share-based payment, the measurement was different for employee and the measurement was different for other parties or the parties other than employees. Again, here is an option. This is a hybrid instrument. So here again what we did, we are measuring X and Y first in case of employees, and obviously this is a double entry. Expense will be simply an addition of these two figures. So this is for employee. This treatment is for employee. Now let's have a look at illustration number 6. Illustration number 6 is this is illustration number 6. ABC Limited. Okay. Actually, two keyboards are in front of me, and sometimes I suppose I'm pressing the keys of others. Anyway, ABC company, yes, ABC company grants an employee the right to choose either the right to a cash payment equal to the value of 1,000 shares of ABC company after 3 months, or 14,000 shares of ABC company after 6 months. So this is equity alternative, 14,000 shares, and 1,000 shares is the cash alternative. The grant is conditional upon the completion of 3 years service. If the employee chooses the share alternative, the shares must be held for 3 years after the vesting date. The face value of one share is rupees 10. At grant date, the entity's share price is rupees 104 per share. At the end of year 1, 2, and 3, the share price is rupees 104, rupees 112, and rupees 124 respectively. The entity does not expect to pay dividends in the next 3 years. After taking into account the effects of the post-vesting transfer restrictions, the entity estimates that the grant date fair value of the share alternative is rupees 100 rupees per share. Pass the journal entries to record share-based payment for each of the 3 years, including entries if settled in cash, settled in shares. See, if we go back to our slide, we can see over here, first of all, we shall measure X. What is X? Fair value of the debt instrument at the grant date. And what is the fair value of the debt instrument at the grant date? And that is in fact, that is basically fair value of the cash alternative is 104,000. This is X, fair value of the debt instrument. Mean if you will have to pay cash, this is the amount which will be paid. Now, what is the fair value of the equity alternative? This is 140,000. The difference between these two figures is the value of Y. Is the value of Y. So if we come back to our slide here, see 104,000 is X in fact, and Y is fair value of equity instrument is 140,000 because that is 1400 shares minus X, which is 104. This means Y is 36,000. 36,000 is Y, and 104,000 is X. No, because these two figures are cumulative. These will vest over a period of 3 years. So what we will do, we will multiply these two figures with 1 by 3 to calculate the liability account and equity account charge for this first year. Y is 36,000. When we will divide it by 3, this will give us 12,000. $36,000 and 104. This is the cumulative figure. But because this is the first year, we divided it with 3 and 3 to calculate the amount to be credited over here in the first year. So this is simply the sum of these two figures. I hope it should be clear. Now, subsequently, what happens in year 2 and 3. See, so far as this 12,000 is concerned, this will remain there. Equity portion will not be recalculated. As we learned in the equity settled share based payment, you will not change the fair value because this figure is calculated using the fair value at the date of grant of that option. So this will not change. So in year 2, in year 3, this will remain the same. You can see from here. See, in year 2, you can see that 12,000 is being credited. In year 3, you can see that 12,000 is being credited. But the debt portion, which is this, is being determined each year. Like in year 2, in year 2, you can see that in year 2, you can see that it is 40,000. 12,000 is remain the same. What is 40,000? You can note that we remeasured the liability portion as we learned in the case of cash settled share based payment, whereas equity portion will remain the same as in case of the equity settled share based payment. So 1,000 shares into now at the end of second year, the price has become 112, and this is second year. So this factor will give us the total liability at the end of second year. We will deduct the liability as we used to do in earlier illustrations. So this will give us the liability portion for second year. Similarly, in year 3, this is further changed because the price has moved to 124. Share price is increasing, and our liability is based on this share price. You can see that your liability is also increasing, but your equity reserve will remain the same. So, do we have any question related to this?
Only 2 questions.
Okay.
Does liability under cash settled can be called as financial liability? Asked by Muhammad Shoaib.
Financial liability. Yes. Who is this gentleman?
Shoaib.
I suppose. Yes.
Right.
Because this will be settled in cash. Determination of a liability does not affect its classification. Yes.
Okay, Rashid Hanif asked the concept of vesting condition or vesting period remain the same in cash settled transactions.
Yes, remain the same. Remain the same. We can have Maghrib prayer break. Then we will continue with the second part of this illustration, which is interesting. Like now you have seen that in over a period of 3 years, we have recognized 3 figures in the equity reserve. I mean, in total, at the end of third year, the total closing balance of equity reserve will be 36,000, and there will be some balance in the liability. Now, what will happen if it is settled in equity? In fact, shares are issued, or if it is settled in cash. So after Maghrib prayer, we will be discussing on this point. Can we mute this?
share. Just squeeze it down.
Okay.
This can be minimized.
Okay. So now we come to the second part of this illustration. We can see from here, I have given here two situations. One is if it is settled in cash. If it is settled in cash, simply liability will be debited and cash credited with the closing balance of the liability. How we have calculated this closing balance? See, in year one, 34,667 was credited to the liability. This plus in year two, 40,000 was credited to the liability. Plus then 49,333 was credited to the liability. So at the end of third year, the liability, total liability amount was 124,000. We paid the cash. So liability is settled. No, before moving to this part, what about the equity reserve? Equity reserve will remain there. Nothing will happen. No adjustment will be made to that, except if management want to transfer it to the other component of the equity. That will remain there. Now, if it is settled in shares, so there will be two entries. First, the whole liability first will be transferred to the equity reserve. We know that the liability is 124,000. This will be transferred to the equity reserve. And we know that 36,000 is already there in the equity reserve. How? Because in first year, we credited equity reserve with 12,000, this amount. And in second year, we again credited with 12,000. And in third year, we credited with the same amount. So this will give us 36,000 already there in the equity reserve. Further, we move this liability to the equity reserve. This means if we add up 124,000 and 36,000, this will give us 164,000. Now, this 164,000, which is basically the sum of 36,000 equity reserve, which is already there, and 124,000 liability, which is transferred at the end of this vesting period. So this is a 160,000 balance in equity reserve. We shall be debiting this balance to make it nil. And because we have issued share, 1,400 share, as we can see from our question, and this will be multiplied with the face value to give us the amount which should be credited to the share capital. The balancing figure will be your share premium. So this is the treatment if your like hybrid transaction is settled in shares. Okay. Now we move further. See, I have tried to plan. I suppose that because we need to cover this concept within this short span of time. So maybe you have some questions, but I'm very sure that when you will see the recording of these sessions, you will be able to get answer most of your question, because all this recording will be available on vimeo.com, I suppose. Anyway, ACCA will be informing you the exact location of this recording. But even after seeing that recording, viewing that recording, you are unable to find the answer of your question. So please feel free to write me. My email address is already with you people. You can find it in the last slide, or you can simply write Abubakar, ABUBAKAR, @bakertillymiq.com. Okay, now move further. No, when the counterparty has, we have discussed, okay, parties other than employees. We discussed the situation of employees. If it is a party other than employees, then first you will measure the expense, as we did in case of equity settled share-based payment. This will be equal to the fair value of the goods or services received on the date of the receipt. So this will become this value, and thereafter you will measure the fair value of X, which is the liability portion. The residual value is the Y. This is the balancing figure. This approach is the same if you recall International Accounting Standard 32, where you issued an hybrid instrument, and while recording that instrument, you bifurcate it into debt and equity, and whereby debt is calculated and equity is the residual value. The same approach is here. Subsequently, at the date of settlement, the entity shall re-measure the liability at its fair value. If the entity issues equity instrument on settle, rather than paying cash for the debt component, the liability shall be transferred direct to equity as the consideration for the equity instrument. If the entity pays in cash on settlement rather than issuing equity instrument, that payment shall be applied to settle the liability in full. Any equity component previously recognized shall remain with an equity. See, I have already illustrated this whole concept with the help of settled in cash and settled in shares. So this is basically the practical illustration of this write-up. Okay. Then is the entity shall determine whether the next situation we have covered so far, the situation whereby the other party has the choice of settlement. Now we are going to discuss when company has the choice of settlement. Concept is very simple. The question is, should the company in this situation treat this as a equity settled share-based payment or share settled, cash settled share-based payment? The answer is, if the company has a present obligation to settle in cash, then this will be treated as a cash settled share-based payment. No hybrid treatment. Or if present obligation is not there, then this will be treated as an equity settled share-based payment. Means single treatment, no hybrid treatment. What is present obligation mean? The present obligation is, in fact, the present obligation is entity has a present obligation to settle in cash if the choice of settlement in equity instrument has no commercial substance. For example, because the entity is legally prohibited from issuing shares, or the entity has a past practice or a stated policy of settling in cash, or generally settles in cash whenever the counterparty asks for cash settlement. So if any of these conditions are there, this will be treated as if the company has present obligation. If none of these conditions are there, if present obligation is not there, then this will be treated as equity settled share-based payment. So the remaining accounting of cash settled and equity settled we have already covered in the start of our discussion. Now, what happened on settlement? Okay, if the entity elects to settle in cash, the cash payment shall be accounted for as the repurchase of an equity shares. Like you have already treated it as equity settled share-based payment. Now you are settling it, but that settlement is being made in cash. Then that equity reserve will become debit and cash will become credit as a repurchase of that equity element. Second is if the entity elects to settle by issuing equity instrument, no further accounting is required because you have already equity reserve and shares are being issued. That equity reserve, like if the entity elects to settle by issuing equity instrument, no further accounting is required other than a transfer from one component. I mean that will become the share capital. If the entity elects the settlement alternative with the higher fair value as at the date of settlement, the entity shall recognize an additional expense for the excess value given. The excess value is the difference. See, at the date of settlement, if you are settling it for a value higher than the amount which you have recognized, so that excess will be transferred to the profit and loss account. Then is the cancellation or settlement. On cancellation or settlement, you will be accelerating the vesting, and any payment shall be accounted for as repurchase of equity instrument granted. Any excess shall be recognized as expense or remeasure the liability at settlement date and account for extinguishment of the liability. We can discuss it with the help of a small example. Like here is an example whereby you can see that a company had granted share options for 2,000 shares. The fair value of the shares was 1 million and the company paid 1.2 million cash to settle the options. Earlier, an amount would have been credited to equity. On payment, an amount of 1 million is debited to equity and the balance 200,000 is treated as an employee-related expense. Effectively, 1.2 million would be charged to employee expense. This is cancellation, settlement, or modification. Simply, if you are paying more, that will become your expense. Modifications. Modification is basically the incremental fair value granted. Treatment is, if any, recognized over the period from the modification date until the date when the modified equity instrument vests. Don't worry, apparently it seems perhaps we are going to discuss something very difficult, but I tried to explain it with a small example. Like you can see from here, what is the treatment? Like this is a small example whereby you can see that Copra company issued 5,000 options with a 5-year vesting period to its employees in 20x5. The options have an exercise price of $10 per share and the fair value determined at the grant date was 80,000. In 20x7, due to a prolonged decrease in Copra's share price, it decided to reduce the exercise price to $3 per share. The fair value of the original share options at the date of the modification is $20,000, while the fair value of the modified share options at the date of the modification is $75,000. Since the modification increases the fair value of the share options by 55,000, determined at the modification date, Copra would not only recognize the $80,000 amount based on the grant date fair value over the remaining vesting period, but also 55,000 over the remaining vesting period. This is the treatment of the like modification. I have included material over here, and you can just look at it. It's very simple with, and I'll be sending you this small illustration as well. So this is about the group, group transactions. And thank you very much. I'll repeat again that there may be some questions. If they are unanswered, even after watching the recording, please feel free to ask those questions. I can mention my email address over here in case you have any question. Please feel free to ask that question, because we have certain limitations during this session. So that's why sometimes it is not possible to take many questions. Anyway, so this is my email. If you want to ask any question, please, or if you want to discuss any specific scenario where this standard is applicable, so please feel free to ask that. And thank you very much for your participation, because your participation encourages us to continue with these sessions. And I'm really thankful to the team, ACCA team, for assisting me and supporting me in holding all this activity. Thank you very much.